How do we at Bander Wealth Management avoid the most common investment mistakes?
Invest in a diversified portfolio of stocks, and you'll notice with Bander in our growth portfolio or our stock market portfolio, we're going to invest in a diversified portfolio of stocks and index funds. Then number two, invest in an income portfolio to match upcoming expenses. So for example, if you're making regular withdrawals, we can forecast. We know what those systematic withdrawals are going to be, and that helps us to allocate a certain portion to your income portfolio or your non-stock market investments. And then lastly, to stick to the plan. There's a reason why we have this plan in place, and we need to stick to it through the highs and the lows. Couple of things. This is our Bander Wealth Playbook, and this is in relation to the growth portfolio, or what I'm referring to as your stock market portfolio. So as many of you know, when you buy a stock, you're buying a fractional ownership in a public company. And then you or us as the stock owner, we can benefit alongside the company. And then we're usually compensated as an owner or a fractional owner of that company through dividends that they may pay out to shareholders or an increase in their share price. Many times people will ask, well, which stocks should I buy? And for us, the simple answer is all of them. A reasonable allocation in all of them. And that's why we like index funds. So said another way, buy a large number of companies that are invested in the US and abroad, some that are big, some that are small, and that sell products within a variety of different types of industries. That gives us good diversification within our stock market portfolio. So why do we want to have the stock market or stocks in our portfolio? It does help to maintain purchase power, to grow wealth, and to stay out in front of inflation. Oftentimes for us as certified financial planners, one of the biggest concerns that we hear from investors is outliving their money. Well, we know that your money loses value over time due to inflation, and that's called the loss of purchasing power. So investing in stocks for a long period of time has historically been a way to have your money keep up with inflation. And I know I was at an educational conference recently, and they talked about the single most powerful wealth generating tool known to the history of mankind has been stock market. It is a powerful tool, and I know that sometimes it can create anxiety or angst, and we understand that. And so that's why we feel that not trying to time the market, having diversification in the market, having accurate expectations can really help ride through some of those highs and lows. And that's a big part of what we do and we expect to provide to you and on behalf of our clients. If you look at this shows over the long term what the general stock market has done. And this goes back over 70 years. And what it is it shows a 1 year what a maximum return has been and what an average return has been for the market over a year. And then also what one of the worst years has looked like. So as you can see, the longer that you can plan to stay in the market and accurately time and manage the portfolio, the better off you can be. And so really, if you look at even over a 10-year period, the maximum return being 19.1%, the average return being 10.57%, and the minimum return being -2%. And that's over a 10-year period within the stock market. There is some power behind utilizing this particular asset class and having it part of a well-managed portfolio. So this is one of the things that we do as part of your portfolio with Bander Wealth Management. Now, what have some of these past declines in the stock market taught us? This is some good data here. So number one, the stock market declines are the last thing investors want to experience. And I hear and see that a lot, and I can understand. But they are an inevitable part of investing. We do see pullbacks from the market. I'm going to provide a little bit of historical background to help put these stock market declines into perspective. I like this data. And so there's a few different types of declines. Since 1953, we show that declines have varied widely in intensity, in length, and in frequency. And so in the middle of a decline, it's nearly impossible to tell the difference between a slight dip and a more prolonged correction. But here's what the data show. So this goes back, this is over 70 years, and it shows us the types of declines here to the left. So whether it was 5% or more, 10% or more, even 20% or more. And we can see the average frequency So you can see a decline of 5% or more in the market can happen on average 3 times a year. A 15% decline in the market will happen about once every 3 years. And then this next column shows the average length. And then this to the far right shows us that last occurrence. And so I find this to be very useful. We do know that market declines are going to happen. They're corrections. And really there's an argument that can be made that oftentimes those are helpful to the market. It kind of pulls everybody back down to reality. It creates buying opportunities. But it's difficult to time. We don't know how long they're going to be. But with this data point here and these numbers, we get an idea to understand that they do occur. There are recoveries, and then it's very difficult to remove the emotion or to know which type of correction we're experiencing when we're in the midst of it. So that's why what we want to do is have time periods that we know that we're not going to need to access that money. And that's why we would counter or complement your growth portfolio, your stock market portfolio with your income portfolio, and what we do here at Bandor Wealth Management. So 4 lessons that we've learned from these market declines is that no one can predict consistently when the declines will happen. I've seen and heard this plenty, and it seems like there's always someone predicting at any given moment that it's going to happen, but really no one can predict it. No one can predict how long it will last, and no one can consistently predict the right time to get in or out of the market. I even remember hearing and seeing a quote from Warren Buffett that said, it's not about trying to time the market, it's about time in the market. And so that is a principle that we've held on to. And then the 4th thing is having cash set aside in advance will prevent us needing to be forced to sell when the markets are down. We've also heard Warren Buffett and many others say the key to the market is to buy low and sell high. But oftentimes human nature is to do the opposite of that. So what we want to do is have cash set aside that could be invested in our income portfolio. That way we can rely on that allocation or that portion of your portfolio to pull money out throughout your withdrawals or your distributions or your upcoming expenses, and then not be forced to sell when the market is down. Do it more under our terms or your terms as an investor. So how much of my portfolio should be invested in the stock market? Well, a simple answer, anything that you don't need for upcoming expenses, and then as much as you can handle emotional. And so I'll give you an idea of how we approach this with a lot of different investors, because your age, your appetite for risk, some of those things will definitely play into this. But what I want to share with you more than anything is by separating that out, that mindset of the stock market investments and then the non-stock market or the income investments, as we refer to them at Bandor. Some people might say, well, why don't I just invest all of it in the stock market, like you said? And I would say, well, the simple answer is we don't want to be forced to sell when the market is down. We know that there's going to be some corrections. And even as we talk about Q3 and Q4, it's likely that we are going to experience some pullback. The numbers tell us it will and does happen. But hopefully this type of framework and mindset can help reduce some of that anxiety and understand that we're addressing it. And so over time, we know that the stock market has increased in value with high probability. But over the short term, it can be up and down and very difficult to stomach. So stocks tend to have big losses on average every 5 years. And so that's why we like the idea of having those expenses and that money that may be needed in the next 5 years set aside. That's where we will use the Bandor income portfolio. So as I've shown here on this slide, at a minimum for your traditional and average investor, we're going to keep at least 24 months of expenses outside the stock market. Now, that might not even mean that you're pulling money out of your portfolio, but just if you had to, or if you did, we want to understand what your 24 months of living expenses look like for you, or anticipated future expenses. And then for some investors, we may even keep 5-6 years expenses outside the market. This is definitely an individual and a customized decision. But the main thing that we're trying to avoid is having to sell during a down market. And as I mentioned, stocks do tend to drop on average every 5 years. Oftentimes people will ask, well, what are you doing with the funds that are outside the market? And that's where we use the Bandor income portfolio. This portfolio is actively managed, and it includes a mix of Bandor custom income notes. And hopefully you've seen and been able to review some of the information we send out about our Bander custom income notes. I'm even going to reference some of our historical data and performance in this presentation, in this video. We're also using real estate, and we even have quite a few different real estate instruments that provide good diversification, tax advantaged income, and much shorter durations and the opportunity to exit if necessary. So there's a lot of attractive features that I'm liking and that we're utilizing within the allocation or within the real estate sector. And then we're using US Treasuries, CDs, and being able to really take advantage of our platform and ability to shop throughout the United States. When it comes to the custom income notes, these are custom investments that we are producing on a monthly basis within our Bander advisory team. They have built-in protections or buffers, and so they're not exposed directly to the stock market fluctuation. And the way I like to present it is they even give us an opportunity to win when the underlying securities or the stock market is down, whatever we're using in that case. And I'll give some examples of that here momentarily. Also real estate, I mentioned we have some investments that we're utilizing here within the United States, even some internationally. We're enjoying and utilizing asset classes like multifamily properties, industrial properties, but getting good diversification. And then the short-term savings instruments and vehicles that I've mentioned. So how do we replenish or utilize the Bander income portfolio? Well, when the stock markets are up, that's our opportunity to sell and to harvest some gains, to take some profits off the table. And then we can redistribute those gains into the income portfolio. But the goal is to fund expenses in advance and on our terms. We don't want to be forced to sell when the stock markets are down or make emotional decisions. So our philosophy on investing is to invest like an optimist, but save like a pessimist. And so what I mean by that is over the long term, we are optimistic that the global economic engine will continue to grow and that we will invest in a big basket of global companies and US companies, and this will be done within our growth portfolio or our stock market investments. But then we're going to save like a pessimist because we know that the stock market is down at times, at a minimum, once every 5 years or so. So setting aside funds to ensure that we don't need to sell at the wrong time is the key. We invest and save in the Bander income portfolio, and that's where we will pull from to cover expenses. When it comes to the playbook for our investing model, we're going to use a globally diversified portfolio. What was hot this past year may not be hot next year. So instead of guessing about the future and trying to pick winners and losers, we're going to rely on academic-backed research. We also know that inflation kills, so we're not trying to time the market and be on the sidelines one day and on the field the next. We don't want to reduce your purchase power. We're going to invest in stocks to help make sure that you can buy the same bag of groceries today in 10 or 20 years from now. Remember, some of the mistakes, we want to avoid the headlines, current events, news headlines, media attention. This can often be distracting. It's all just noise. So we prefer to zoom out and follow trends rather than getting sucked into what's trending now or what's the latest and greatest. And I'll remind you that when it comes to investing, patience wins. The most successful investors have one thing in common: patience. They're investing for the long term. There really are no shortcuts to this. Those are just gambles that may or may not pay off. And so what we want to do is stick to the core principles of investing.